Good evening or good morning whenever you are listening to this. I hope you're having a great time. I'm going to be talking over the datasets for February the 13th, 2025, and also be going over what's going on with the SPY. And I'm also going to be talking just kind of some analysis of where I'm seeing the datasets going recently, seeing how we had the CPI come in fairly hot today, which was something that I did discuss in my video yesterday. I said that there could be an expectation of seeing those rates go up. But anyway, let's go ahead and get started with talking about data. Sorry if I sound sick still. I'm still getting rid of this pesky pneumonia, so I do apologize. Anyway, let's go ahead. So we have the jobless claims. It's a weekly data set. These have been holding some fairly, what's the word? They're at high levels, right? So the initial jobless claims, usually we want to we want to see that under 190K, give or take. It's been holding over 200K for quite a while. Same with the continuing jobless claims. We usually don't want that to be near the 1.9 million, and it's been hovering near the 1.9 million for quite a while. And just to highlight this, this graph doesn't show it very well just because the amounts are um, they're large amounts, so you're not going to see a whole ton of swing in this. But this is the last year. Um, we've seen the jobless claims go from all the way from 1.7 million up to 1.9 million, and I believe there's actually one print that was close to 2 million. So it's on the rise, right? Um, Same with the initial jobless claims. We had some weakening in November towards December, but it's starting to climb back up again. Um, that's something we have to be concerned about as we're starting to see the yields increase in the treasuries. But the thing about the jobless claims is that with those rising, we should be seeing the yields coming in lower, not higher. So we just have to be really basically watching this week to week, see if this is actually continuing to rise or if this is just a blip where we're gonna start seeing these jobless claims actually starting to dip down again. Um, the other data sets should actually correlate that we should see the jobless claims coming down. That's if the other data sets are actually true. Uh, these are from the BLS, majority of them, and many of those data sets get revised down months to a year later. In March, we're actually going to see the revision for the jobless claims or the unemployment for 2024, and it's very likely going to be extremely high, just like it was in 2023. With that said, though, the PPI comes in at the same time as jobless claims in the morning. It looks like the consensus is expecting a slight uptick, and I'm going to agree with that, just based off the CPI. Usually the PPI can be correlated to the CPI, and not exactly a lagging indicator, but it can be, usually you can look at the PPI and make a good determination based off of what the CPI gave us. So if the CPI gave us a hot print, then very likely the PPI is going to show, is going to reflect that. So I am expecting the PPI to come in a lot hotter, um, whether it's this zero point 0.3 or even 0.4%. So with that said, I just want to go over some quick notes about the data sets just over the last couple days. And what I mean by data sets, it's more of the narrative and what's actually going on with some of the big things. So a lot of analysts have suggested that uh, oil rising is going to help the rate cut thesis, which means that the price of oil going up is going to suggest that the Fed is going to have to cut rates in order to balance that. I don't believe that's true. Uh, Trump plans on expanding on drilling and fracking and all sorts of oil generating industries, so um, it's not likely we're going to see the price of oil continue to rise. It's very likely that we actually see oil drop significantly. Um, let's see. I already talked about the jobless claims. I want to talk about the yields because this is something I discussed back in November 2023, and for anyone who's actually been following me that long, um, I was very against the Fed doing their pivot, and what that pivot was changing from hiking the rates to now considering pausing and cutting the rates, and that's what we saw in 2024, right? We saw a lot of pauses and a lot of cuts. Um, Many of us that were trading SPY and everything at the time were expecting an additional hike to come in that October and November, but we didn't see that at all. That's when, we had that massive pivot, which caused the market, I think, to go from, I believe it was 402 or 408, um, all the way back up to 500 within, a couple weeks, or, a couple months, I mean. Uh, and then the narrative just completely swapped to um, pauses and cuts for the year, and it was very it was the narrative was supportive of that. We were seeing the jobless claims ticking upward. We were seeing hiring uh, basically closed off for most of the year. We were seeing unemployment on the rise. So it made a lot of sense for the the pauses and cuts to be occurring like they did. But the problem is that all of a sudden now we're seeing extremely strong data coming out of these data sets, and whether this is the true data now or front run data, whatever it is, it's completely on a different. How do I explain this? It's like the economy just entirely did a 180 on what was happening, because what was happening was uh, the labor market was starting to crumble. People were not able to find quality jobs. A lot of the tech jobs were closing off, and it was looking very likely that we were going to start seeing layoffs happen, and that we were going to start seeing a lot of recessionary signs. But all of a sudden, we see incredible strength in the hiring, or not the hiring, but incredible strength within the jobless claims. I mean, the jobless claims were dropping significantly. We were seeing the yields dropping. Um, there was a lot of signals to suggest that things were not going to head this direction. But now all of a sudden we're seeing the yields climbing. We're seeing uh, economic strength increasing. If these jobless claims and everything don't go through, and by going through, I mean if we don't get hotter prints tomorrow, right? Um, then, or I mean today, then we should be kind of expecting inflationary, uh, inflation to start making a comeback. We already saw that with the CPI slightly today, so, or yesterday, I mean. So, the last thing I really want to go over, besides the yields going back up, is that, the uh, the government budget deficit has increased massively over the last year. For this month alone, it's gone up, I believe, to over 100 billion compared to last year, where it was like 22 billion or 24 billion. Massive increase. It's increased by over 88 billion. Um, and one of the issues with that is that when we're issuing debt, so when we're issuing treasuries, uh, that's significantly hindering our ability to continue paying our interest rates on these debts. Um, and even with the cuts from Doge and everything, it's still very difficult for us to continue to pay these coupon rates. I mean, whole 2024, all taxpayer money went straight to paying interest rates on these treasuries. So it's weird to see that they're wanting to enter into a phase of wanting to issue more debt. So what I'm starting to watch now is what the credit agencies are saying. So what Moody's is saying, um, and seeing if they're wanting to consider possibly downgrading the U.S. debt. And I know it's far off from now. We still have quite a ways away, but the we're running out of ways how to pay this debt in a realistic manner. But I just wanted to quickly touch on that thesis is that we're kind of in between of either the labor market's actually failing and we're gonna see weakness, or everything's picking back up and inflation is back on the rise. So just be aware of that as we move forward the next couple of months. Um, Tomorrow we have some earnings. Let me just take a look. I had it written down, but it closed out. I'm sorry. One second. Yes, we have Coin, Palo Alto, Applied Materials, and DraftKings. I'm not really gonna play any of them besides Coin. I always love playing Coin. And I'm not gonna go over the Bitcoin chart or anything right this moment. Maybe I'll write a Weeble TA about that tonight or something. But I enjoy playing Coin, so I'll probably be taking contracts on it later today. Just a quick reminder before we get into the technical analysis. If you've been finding value in my insights, consider joining my Patreon. For just $12.99 a month, you'll get access to my trades, courses, and powerful tools to help you grow as a trader. I'd love to have you be a part of our team and community. And it's less than 43 cents a day. So if you'd like to join, click in the link in the description. Thanks. So with that said, let's go ahead and go over the daily chart. As usual, I want to discuss the moving averages and the Bollingers. Now, we did close under the 5 mile today, so currently the 5 mile is at 604.12, and we closed at 603.36. So that's very likely meaning that we're going to open the 5 mile around the 603.70-ish mark, give or take. With the overnight, it's already pushing quite hard, but it really does depend on what we see with the PPI data in the morning, whether this overnight 605 is going to hold or not. We have the 10 mile at 603.12. It's starting to get close again to the where the 5 mile is, especially if we have bad data in the morning, then we can expect um, the SPY to close under that 603 area, which would pull the 5 mile again under the 10 mile, which would be one of the first initial bearish signals. But the thing about that is that we also have the 20 mile right at the 602.31 mark, which if we get a major sell down today, then we could absolutely see the 5 mile pull under both the 10 mile and the 20 mile within a single session. So that's something you have to be aware of, and why that's something that's reasonable too right now is that that we have the lower Bollinger currently at 592.98, so that's gonna pull up to like 593-ish, 594. Um, it's very close to strike range within the market. I mean, that's only a $10 move down from where we're at right now, so that's very reasonable. If we have like an extremely hot data set today. Um, But I'm also looking at the upper Bollinger too. We've been having that consolidate downward. It's currently at 611.63. So again, that's only $6 away from us right now. Uh, we've been having the daily ADL pull up quite a bit, which again, I say this in pretty much every video, but that's the money inflow and outflow. So if we're seeing this push up higher, then that means just more money is pouring in. And we saw that today, right? Let's pull up the 30-minute chart for a second. I want to turn off these Bollingers and everything. So we sold down all the way to this 598 with the CPI print, but pretty much bought the entire day up. And what this creates is a fair value gap. Uh, what that means is basically if this didn't exist, the market didn't really go anywhere. This sell-off was entirely bought up by the dealers, uh, which means that we're basically right back at the start of where we were before we got that news. So the market took the news poorly, but not poor enough to actually hold it. And this creates a bullish structure at this point. It now creates a cup. Let me go ahead and draw this out really quick. So this creates a cup right here. And from this cup, we should expect a handle to form. Yeah, that looks a little better. And what that does is, let me pull up the hourly, is this now, this cup and handle is not showing the full top of the cup, but this completes a structure right there, which allows this larger cup to create more liquidity. And I'm going to show you what I mean by that. This is now creating an inverse head and shoulders. So very likely if we chop in this area again tomorrow or have a slight rise to that like 606, 607 area, that's going to create enough liquidity to fill this cup right back up to that 608, 609 area. So that's kind of what I'm looking for structurally on the bull side, um, is for that liquidity to play out and, fill that cup and again challenge the top of this selling channel. It's been extremely, extremely strong. Um, if we're looking for a bear structure to finish out, sorry, then what I'm looking for is for a large cup to form here. And how could this fill out? Well, we have the bottom Bollinger again at the 592, 593 mark. So that's right in this area, and there is liquidity built here. So it could absolutely take that mark and push down, give us a bottom Bollinger move, and complete this cup out. So it's very within reason to still reject and pull downward into that cup. Just we have to have to be aware that like the ADL has been really strong almost on every time frame. We do have a double bottom here. We have, that inverse head and shoulders I was talking about. We have the left shoulder right there, the head, just need the right shoulder, and then, that would form a breakout. This is a large cup and handle as well. So there is the cup, there is the handle, and that would allow a breakout as well. So with that said, it's really going to rely a lot on what the PPI data gives us in the morning. We don't really have any data sets later in the day or anything else that's going to really push the market. Uh, for the earnings, we have Palo Alto and Applied Materials, but that's not really something that's going to shove the market one way or another. I mean, granted, if we do have like Applied Materials absolutely bombing their earnings, then that would probably hurt semis pretty bad. But we saw the dip entirely bought up today. If tomorrow gives us somewhat of the same reaction, then that's just going to create the right shoulder on that inverse head and shoulders and allow us to pop upward, fill out the cup, and have plenty of liquidity to push upward and break this channel. If we somehow get to that 610 again, then we have to watch out for this large cup and then form a handle off of that. This upper consolidation channel is going to be quite hard to break for a while. very likely anyway. That's just why we're building so much liquidity right here. But the last thing I do want to go over is that what I am also seeing is that we're in a controlled sell-off. So if we do get this massive rejection tomorrow, then very likely this is what's occurring is that uh, the market's very likely running mostly off of selling options. So uh, you've seen the volume just be pretty abysmal the last few days, and by the last few days I mean the last few months. Um, I mean, we've had some of the lowest volume days in years while we're pushing all-time highs. And how does that really happen? Well, it's not retail buyers, it's not funds really buying those levels up. It's the dealers. They're seeing that okay, people are wanting to buy calls at this level. I can buy shares and push this level and sell calls. Um, and that's really what's going on right now. So if this is going to push higher, then the dealers need to see that people are wanting to buy calls higher. If not, then this can turn into a massive head and shoulders. Just to illustrate that that is a terrible head, but I don't care. I'm sorry. This can make a massive head and shoulders right here, all within this consolidation channel, and that would absolutely break us down um, quite a ways. And the reason why I'm bringing this up really is because with the higher inflation and everything possibly happening, that would give dealers a really, really good uh, reason to want to have a massive sell-off and basically reload for, new all-time highs because that's what happens when the yields increase. When the short-term yields increase, equities have to beat those short-term yields. And how do you do that? Well, you pump the market. So, um, if we are entering higher inflationary times, then we're very likely going to see all-time highs happening on the SPY. And I'll talk about that correlation a little later in a different video, as this one's starting to get pretty long now. So I'm going to end it here. Uh, with that said, pay attention to what the data sets bring in the morning. No, no reason to force any trades. Either we're going to see the bullish structure and take us upward, or we're going to see this fail and, break down. And really look at the 20-minute ADL, the 20 to 30-minute ADL. That tells you exactly what's going on. Look at today. I mean, we had the drop, and then boom, massive money just flowing straight into it. And that's how you know, and that's how many of us knew this morning to just buy the dip, and you know, we were going to travel upward again. The ADL was telling us exactly that. There was a opportunity later this afternoon where we saw a small head and shoulders forming right here, and the ADL was what was telling us that we were going to get that. We took puts, had a nice play right there, and then took calls again, and now we're on the way back up. So I'm gonna end the video there. With that said, um, trade safe tomorrow, or trade safe today, everybody, and I hope you have a great day.